Hi, this is Chris German from the Apartment Dealer, and happy 4th of July if you're watching this video on the 4th. And what better day to discuss Uncle Sam? And when I say Uncle Sam, of course, I'm referring to taxes. You know, within an industry where oftentimes, maybe not you, but many owners understate their income, overstate their expenses. How do you keep yourself out of hot water? How do you really maximize your deductions legally and ethically? And how do you take advantage of this new 20% deduction that the government is offering landlords? If you are unaware, I'd be surprised that you're unaware, but if you haven't heard, there is a way in which you can deduct 20% of your rental income. And I'm going to share with you a clip from our previous Apartment Owners Educational Luncheon, which took place this last March, where with us we have Mr. Stephen Hall, EA, CPA. Stephen Hall's family owns Robert Hall and Associates. They've been in the accounting business for many, many decades. And they really do work with investors like you, and they are investors themselves. They own investment property. So you can bet that they have scoured the IRS code to find every which way to mitigate their taxes. And so again, I want to share this clip with you. Steve dives into this 20% deduction as well as many other topics that help you keep as much money, net cash flow in your pocket. Let's take a look now.
So today, like Chris said, we're going to uncover the benefits of the new tax reform. How many of us are familiar with the new 20% pass-through savings that for landlords? So if you look around the room, not too many hands are going up. How many of us are utterly confused about what to do with the new tax administration? That's the norm. There's a lot of confusion. So my goal here with this presentation is to unwind that confusion with a few charts and graphs. So who is Stephen Hall? I am the president of Robert Hall and Associates in Glendale, California. I speak in front of dozens of real estate groups, associations, including the Apartment Owners Association and other groups in front of landlords like yourselves on a frequent basis. And I personally own real estate and apartment buildings, so I understand the needs of landlords and what you go through day to day. So right now, if you're an individual taxpayer, the tax rates have been lowered. You'll see at the very top tax rate of 500,000 plus is lower. It used to be at 39.6%. It went down to 37%. So that's good news. You save 2 percentage points if you're at that top bracket. And downstream, you'll see there's some additional savings. What's notated here is the 22 and 24% brackets. Those used to be as high as 28%. Most people fall in the band of earning between $38,000 in taxable income and $150,000 in taxable income. So you'll see those rates were 28%. They're now dropped to 22 and 24%. If you're married, you'll see the brackets have been adjusted a little bit to where the 22-24% brackets are now between $77,000 and $315,000. And most of you in this room will probably fall in that bracket beneath the 315 category. So that is good news. 199A is the new word for kind of like 1031 exchange. We've all heard the term 1031 exchange. 1031 is section 1031 of the Internal Revenue Code. 199A is section 199A of the Internal Revenue Code. That is the code that the Trump administration created and amended to allow taxpayers, landlords, to get a 20% deduction on their rental income from rental property. So let's talk about deductions that are disappearing. If you have a fire, or if you have a damaged asset or a theft loss, and if the president of the United States does not declare it as a disaster zone, you lose the deduction. So what you're going to see is the president more often than not claim zones as federally declared disaster zones. For example, how many of us are familiar with the floods that are happening in Nebraska right now, that's flooding the Midwest? You'll hear the president talk about declaring that whole area as a disaster zone. And the motivator there is to give those citizens a tax deduction because they have a loss from the flooding that's occurring right now. The second impact under this new code is if you're an employee, you can no longer deduct your business expenses. This has heavily impacted wage earners. And this is why the folks in this room are fortunate. If they plan properly, they could deduct their expenses as property managers as well as landlords. Now, if you do not have a small business and you do not have a rental property, you can no longer deduct your tax preparation expenses or your moving expenses. And if you're getting divorced and you plan on paying alimony, starting in 2019, alimony payments will no longer be deductible for new divorce settlements. So this is an important planning point for 2019 forward. If you tithe to charity, it may make sense to bundle your tithing for 2 different years, for 2019 and 2020, in a year that you're going to have a significant taxable event. So you have to do some planning so you can bundle your donations in 1 year, such as, for example, in 19, so you can exceed the $24,000 ceiling, or take the standard deduction in 2019 and take the itemized deduction for your tithing in 2020. So it's going to be important to plan and cherry pick what year you want to take the tax deduction to maximize your deductions on what's called your Schedule A of your tax filing. And remember, Schedule A only applies now under those new rules for strictly charity, your mortgage for your house, and property taxes and state taxes. Now remember, the property taxes, state taxes is capped at $10,000 now. So there's a very few areas to save you money on your taxes on the Schedule A. Where you're to save your money is going to be on the rental property schedules and your small business. This is going to be the most important slide for us to talk about today. When you look at this chart, you'll see to my right or to your left, when you're an individual and you have a pass-through activity could include your rental properties or your small business. So when you are in that orange truck in that example, profits from that area, from that category, is subject to the qualified business income deduction of 20%. Now, there are some strings attached. The Treasury Department just issued some rules. The rules are, if you manage your rental property and you're hands-on, you get to deduct that first 20% of profit. So let's do an example. If you spend if you have a net income of $100,000 on your rental property, and you spend over 250 hours managing that property, the government will give you a $20,000 tax deduction for that property. But if it's a triple net property, for example, if you invest in an apartment building in Florida, where you're a 3% owner of it, and you earn $100,000 in income, and you spend an hour a year on that property, you will not qualify for that qualified business income 20% savings. So this 20% savings only applies to landlords that spend at least 250 hours managing the properties. And the reason why I'm stressing that point is because how many of us remember a couple years ago, if you had losses, you wanted to become a real estate professional and deduct your losses on your tax return? Do all of us remember those years? So during that period, the government, all they would want to do is test how many hours you were actually participating in the real estate industry. And the rule typically was you had to spend 50% of your time in real estate and 750 plus hours a year to manage the real estate to deduct your losses. Under this qualified business income arena, the government has a completely different set of rules. They want you to keep a diary proving you spend 250 plus hours managing the property annually to qualify for that 20% qualified business income deduction. Now let's talk about the rules. What qualifies that qualified business income deduction? The activities that qualify are you managing the contractor, fixing the kitchen and bathrooms, you collecting rent from the tenants, processing an eviction, dealing with the tenants on evictions, collecting checks, making bank deposits, things of that nature. would be activities for the landlord. Now, what does not qualify as the activity of managing that property? The areas that do not qualify is the time you spend refinancing the property, the time you spend handling your bookkeeping for your financial affairs, or talking to attorneys, doing some estate planning in regards to your rental properties do not qualify. So the rules are very narrow. And as a result of these rules, we're going to put together a checklist for all of you. So that way you can follow that checklist and keep a diary of where you spend your time. So that way if the IRS ever audits you to question that 20% deduction you did take on your tax return, you'll already have a diary prepared to show the IRS. So that way you can keep that 20% deduction in place and get a zero, no change result of your IRS audit. So the key to minimize your fear and your risk is to be prepared and to keep a good diary and good records of where you spend your time. Because for landlords, the biggest area that the Internal Revenue Service likes to audit is not necessarily the money that you spend or the income you deposit in your checking account, is time. They want to see where you spend your time to either deduct the loss on a rental property or to save money on profits from your rental property. Does that make sense? Good. Now to your right on this chart, there are two different categories. There's the corporate category and the individual category. When you have a pass-through corporation, such as a subchapter S corporation, you may qualify for this qualified business income category as well. But in order to qualify, it has to be a business that's not considered a professional service. What I mean by that, it can't be a doctor's office, cannot be an accounting firm, it cannot be a law firm. But it could be a property management company. And the way they weigh that decision is based on staff. How many W-2 employees do you have on your payroll? And also, how much are you directly involved in operating that business? Now, keep in mind, we're talking about a business diary of journaling your time, not necessarily a landlord diary of journaling your time for being a landlord. So it's two different characteristics. Now, those of you that are real estate agents in this room, if you're a real estate agent, you do qualify for that 20% savings under this new law. So this has been a big bonus for real estate agents to take advantage of the new law if you have an S corporation. Now, a big question we receive often is, which entity here is right for me? A limited liability company or a subchapter S corporation? If you're a landlord and you own real estate, you want to procure a limited liability company. Now, fortunately, Steve Esperier is here today, so he'll be able to go into detail on the differences from a legal perspective, what an LLC could do for you versus other entities. And S corporations are great for business owners.
I hope you found that clip informative. If you have any more questions, typically I would say contact our office, but I'm not a CPA. I'm going to defer you to your accountant. If they don't have the answers or you don't feel like you're getting the right answers, then by all means, please contact Steve Hall. He's with Robert Hall & Associates. They're located in Glendale. Our next luncheon will be in October of this year. Now, if you've never attended and you haven't attended because you assume there's some type of sales pitch, I have to tell you, and I've said it many times, there's no sales pitch whatsoever. This is something that we put together to give back to the owners, to keep you informed, up to date of those items that are impacting your ownership. Maybe you've been to other trade associations, other brokerage firms, market updates and things, and it is a big sales pitch, and for that, I apologize. But this event, I've pulled together legal advice, accounting advice, market forecasters, capital markets. Everyone involved in the event itself is an investor themselves, so they're not just giving you a textbook answer. They're speaking as from the landlord's perspective, practical, from the day-to-day aspect of owning multifamily. There's many things that I'm sure we're going to be discussing come this October. Right now, we're under the threat of statewide rent control. There's individual cities and parts of the county that are taking on rent control as we speak, or their version of it. The state is contemplating forcing you to accept Section 8 tenants. So needless to say, it's not getting any easier as an owner. We will tackle all these topics and any that may come up between now and October to ensure, to the best of our ability, to the ability of the speakers involved, you have that information that will impact you as an owner to help you move your portfolio forward in any which way, any manner that we possibly can assist you. So on this 4th of July, again, we're all grateful for our freedom and for this country. We're grateful to be entrepreneurs, to have the opportunity to own real estate, to have rights to our properties. And with that, though, I'm going to wish you positive cash flow, tenants who behave, and much protection from Uncle Sam. Chris German, the apartment dealer. Until we talk again, thank you.